Options are a great way to leverage the power of stocks. Instead of making $10 on a $10 stock move, you can make hundreds or thousands of dollars. And of course, it goes the other way with losing it as well. Today I'm going to teach you all about options. We'll look at the definition of what an option contract actually is, simple it down into a lemonade stand example, and then bring it back up and give you an example of a Tesla option contract. I'll take you step by step and make sure you're understanding every concept along the way. To get us started, what is an options contract? An options contract is an agreement between two parties, allowing the recipient, or the buyer, the right but not the obligation to make a transaction on an underlying security at a predefined price in a predefined time frame. So deep breath after that one. I know that's a lot of words. We're going to spend the next few minutes diving into those words, breaking it down, and I promise you by the time you leave this video, you're going to understand what an options contract actually is. So let's simplify. Let's say you really want to start trading stocks on your own, or even options, and maybe that's why you're watching this, and you want to open up a Robinhood account in order to do so. But your parent won't let you. They think you're just going to lose all this money, and they don't think it's worth it for you to do it. You tell your parents that you have an idea, that you're going to open up a lemonade stand this summer right outside your house, and that if you can earn money from it, you get to open up a Robinhood account. After a bit of discussion back and forth, you and your parents agree that if you can earn $100 at this lemonade stand before the summer ends in 3 weeks, that you can put that $100 into Robinhood. So let's take this example and compare it back to the definition of an options contract. An agreement between two parties. You made an agreement with your parents that once you earn that $100 selling lemonade, you get to open the account on Robinhood. And they agreed this was a fair deal. So if you don't earn $100, you don't get the reward, you don't open the account. But if you do get $100, you do get to open a Robinhood account, put that $100 in if you want to, and start trading stocks or options. The next part of our options contract definition says that the recipient or the buyer has the right, but not the obligation to exercise the agreement. So taking this back to our example, let's say you do earn that $100 in your lemonade stand over those 3 weeks, but now you look at that $100 in your pocket and you decide you don't really want to open a Robinhood account anymore. Instead, you want to go ahead and spend it on a video game. This is totally okay, and you're not forced to exercise the contract you made with your parents. It's your choice from here. Next part of our definition states that we make a transaction on an underlying security. The transaction here is opening an account, and the underlying security is Robinhood. Next, we have at a predefined price. In our agreement, we decided that that $100 target is where we needed to get to. If we can hit that $100 target, we get to open the account if we want to, but if we can't, we don't get to open the account. And lastly, a predefined time frame. As we stated, the $100 goal has to be made by the end of summer in 3 weeks. If we don't make $100 by then, our part of the deal fails and we don't get to open up a Robinhood account. So now that we've broken down that definition, let's actually transfer it over into what an option contract actually is. So an option, just like our agreement with our parents, is a contract that one person buys and one person sells, and they come to an agreement on. All options contracts have a potential transaction of 100 shares of whichever stock the options contract is stated for. This is what the agreement is on an options contract. Both parties understand this when they either buy or sell this contract. As an example, let's say you're buying or selling a Tesla option. This actually means that you're talking about an agreement to buy or sell 100 shares of Tesla as the potential transaction of this agreement. Note that this 100 number is extremely important, and it's known as the contract multiplier, and unfortunately it's pretty unintuitive. Exchanges and brokers don't really tell you that that's happening. It's almost meant to be known as a common sense sort of thing. So the transaction that we can make if we're the buyer of the contract would be to buy 100 shares of Tesla, where Tesla is the underlying security here. And again, note, this is the right to buy the shares, not the obligation. You don't have to buy the shares, and as you'll see in the next part of this series, more often than not, these contracts aren't exercised, and you don't need them to be exercised in order to make money. When you buy the option, two parameters that are included are the strike price and the expiration date. The strike price is the predefined price, where going back to our lemonade stand example was the $100 target, and the expiration date is the predefined time frame, where again, going back was end of summer for us. So let's put that all together. Let's look at an example. With Tesla, you can buy an option contract right now with a $500 strike price and an expiration date of September 28, 2020. This contract gives you the right, and again, not the obligation, to buy 100 shares of Tesla at $500 anytime between now and September 28th, 2020. From the person who sold that option contract to you, the other half of the agreement party. Now, even though your parent was kind to you and gave you the deal for free about opening your account, in order for anyone in real life to actually sell you this option contract, they of course need to have a reward on their end. And that's what we call the premium, or the price you have to pay to actually buy this contract, to give you the right to buy these shares of Tesla at $500 in the future. Depending on which strike price you want and which expiration date you want, the price of the premium is going to change drastically. You could pay anywhere from just a couple of dollars to open one of these contracts to hundreds or even thousands of dollars. I hope this helps clarify what options actually are and what you're buying or selling when you're trading these options contracts. If you enjoyed this video, please smash that like button and hit subscribe for future similar content.